Let's read a book.
What are the two most powerful words in the English language? The two most powerful words in the English language are I am. Because what comes after I am will shape your life. What you speak after and shape your life. To achieve, I believe that I am capable. It's all attainable. And what you speak after the words I am will shape you. That's what will really make or break you. So be careful what you say. I'm gonna take you. Stay strong and positive and you will make a breakthrough. You say that you're stuck and you're stressed and you are, but if you wait for the stars and you shoot, you'll go far. It all comes from within. Just think about it. If you believe that you're great, you will attempt great things. When you affirm I'm strong, you know the power that brings. The words you say you when it flies away. Make sure every day look in the mirror and say, I am. Repeat it every day. Don't let your power go to systems into incantations. I like to hit power. That's from my animation. This is your recreation. No more procrastination now. Just let the words I am. The options. I am anything and everything I want to. I'm just saying the rest of the time that you are. Just believe you will fall. It all comes from within. Just think. Lead to action. Over time become lead to long, lasting results. Hello, everyone. I'm so super excited that you're here. It is a new night. We're starting over with lesson 1. And I'm just so happy and grateful that every one of you are here. Let's see who all we have. Hey, Annie and Carolyn and Selena. Hey, Chaz. Coach Bryant, Cynthia, David, Dolores, hey Dynasty, hey Greg, Joanna, John Kennedy, Ladale, Lone. Okay, great. Michael, hey, Nate, Rachel, Rick, Rose, Susie, Terrace, Tiana, Trisha, welcome guys. Okay, so tonight we are starting with lesson 1, and it's actually like not even included in the syllabus. This is absolute Forex basics. And because we bring, everybody in that's wanting to learn to trade, to me, it's really important that we start with the absolute basics, the terminology, and all of that stuff. So I hope that everyone has your Forex notebook just for your notes for class. I hope on your first page of your notes you wrote out your why. I hope on your second page you wrote out your commitment. I want everybody right now, I'm super pumped to type in the chat, I am a successful trader. I am a successful trader. While y'all are typing that, I'm going to talk to you a little bit. Guys, this is just going to be 2 weeks. This is going to be 2 weeks of your life that I need you to commit to me. I'm going to be here every single night. I'm going to commit to you to help make your life better, okay? I am. Now, there's going to be, especially, if you have tried to learn Forex before, maybe, you've been in other programs, and maybe you've even went through part of this syllabus by yourself. There are going to be things that you've heard. There are going to be things that you know, and that's okay. I need you in this class every single night, guys, every single night, whether you think you know it or you don't, because repetition equals what? Repetition equals what? Come on, somebody tell me. Drop it in the chat. Repetition equals retention. Yes. Okay. So anyway, even if you've heard it and even if you don't, just be here every single night. And especially for the people that are just starting out new, this is going to sound like a foreign language to you. And do you know why? Because it is. This is going to be a brand new skill set. We're fixing to talk about terms you've never heard of. And you might not even just take good notes. You might not even remember them when we get off the class, and that's okay. Read over your notes again. Every night we learn a little bit more, and it actually builds off of what we have learned before. Hey, Kevin, glad you made it. So while you might not understand a thing right now that we're talking about, it's okay, because I was once there too. And I guarantee you, if you just keep coming back, if you come back every single night, at the end of the 2 weeks, you're going to be like all my other classes. And at the end of the 2 weeks, we'll do like a little graduation thing, because you guys are going to be trading. Who is excited? If you're excited, drop a 333. If you are excited, yes, I'm super excited for you guys, because we are totally about to change the direction of your life. So we are going to get started. Give me just a second. All right. Every time I try to like have all this set up for class, I end up like losing you guys anyway. So I'm trying to see. Let me get the so I can see the chat. Okay. And oh, there we go. Oh, perfect. And then if you have any questions, guys, you know, you can always drop them in the chat. Okay, guys, write this at the top of your paper. All right, Forex Introduction. Now, for those that don't know about what Forex is, I'm going to just tell you a little bit about it. You don't really have to write anything down, but Forex, it's abbreviated FX. It's an acronym, okay? It's short for foreign exchange. This is by far the largest financial market in the entire world, okay? The Forex market sees roughly 5 trillion US dollars of trade volume on a daily basis. Okay, if you guys were to compare this to the stock market, it sees about $20 billion of trade volume on any given day. Okay, 20 billion versus 5 trillion, guys. Okay, Forex, it's the trading of different countries' currencies. Okay, you're also going to see various currencies exchanged for commodities or cryptocurrencies. These exchanges, they're all included under the umbrella of the foreign exchange market, okay? A lot of you participate in the Forex market without even realizing it. When you travel to another country, you got to exchange your native currency for the currency of the country you're visiting at the current exchange rate, so that when you get there, you can purchase goods and services, you know, while you're over there. So then when you're ready to return home, you exchange the currency back for your native currency. And this time, you know, it'll probably be at a different exchange rate so that you return with your currency, okay? And a lot of times when you do that exchange back, you have made money. So when you do this, congratulations. You have just participated in the Forex financial market, okay? Now we're going to talk a little bit about who trades Forex. Okay, there are many participants in the Forex market. Okay, we have got individuals, like we just discussed, how regular average people participate in the Forex market during their lifetime. Okay, so many, they only exchange currencies while they're traveling. And there are some who trade currencies to turn a profit. Okay, you are going to hear this referred to as retail traders. Okay, and it's estimated that retail traders, they only account for 5% of the overall trade volume in the foreign exchange market. We are retail traders, guys. Next, we have the corporations. That's large companies. They trade quite often in the foreign exchange markets. Their participation, it's substantially increased over the years. And we've seen a rise in like international businesses. We've got a widespread adoption of more open global economic policies. In fact, it's not uncommon for a large corporation to reference and analyze the exchange rate for goods and services before they carry out their transactions. Okay, so we've got individuals, retail traders, we've got corporations. Now we have banks, okay? Average banks combine to account for more trading volume in the foreign exchange market than any other entity. Most of these exchanges take place in the interbank market. That's where banks conduct currency exchanges with one another electronically. There are many reasons why the banks participate in the Forex markets, okay? And I just want you guys to know that your bank also does trade your money in the Forex market for financial gain. So they're making, you know, millions and millions and millions of dollars off of your money. And what do they give you? Like 0.02%? Okay. Okay, so individuals, retail traders, corporations, we have banks, and Institutional investors. We've got institutional investors. Okay, this is another significant source of transaction in the Forex market. Institutional investors like hedge funds. They control substantial equity in the private sector. They typically carry out a sizable portion of their portfolio's position in the Forex markets. Okay, so and then we have the governments. Typically, governments participate and influence the foreign exchange markets via entities called central banks. Central banks have an incredible influence in the Forex market as they control a nation's interest rates, which directly impact supply and demand for currency, okay? And therefore, it directly impacts that currency's exchange rate. These central bank entities also have impactful economic tactics to stabilize their own currency between the constant inflation, okay, or recession continuum. So you can see, you know, there's quite a bit of participants in the foreign exchange markets. And this is what contributes to the incredible amount of money that's being traded on any given day. We're going to go further into detail on all the market participants, the overall structure of the foreign exchange market in a later section, okay? But first, guys, let's talk about the retail traders. Because, you know, in the past, Forex markets weren't very accessible for average individual traders. However, you know, the world's changing, and it's changing fast with globalization, technology advancements, economic, financial, fundamental changes in society, and it's just an overall shift in the way people are living their lives. It's opened up access to and really increased the popularity of retail trading. Okay, so now we're going to start taking really good notes. We're about to start talking about the Forex terminology. Make sure that y'all. Oh, sorry. Oh, are y'all still there? Okay. All right. We're going to talk about some currency abbreviations. And guys, this is a foreign language you're learning. So once again, don't trip out that I'm throwing this stuff at you. Just take really good notes and make sure that when you get off of here that you write things, you know, that you go back over your notes, okay? Because in the financial markets, okay, right, currency abbreviations. In the financial markets, almost all assets carry an associated abbreviation. And this is just an example. You may see the company Microsoft abbreviated as MSFT, okay? You see the metal gold, it's abbreviated as XAU in the commodity markets. And the reason that it's abbreviated XAU is, do y'all remember the periodic table of elements in science, biology in high school? That is the abbreviation for gold on the periodic chart, XAU. Okay, the same principles apply to the foreign exchange markets. In the world of Forex, all currencies are abbreviated. You're going to need to know and understand these abbreviations like the back of your hand. And you're going to, okay? I want you to write some of these down. USD is the US dollar. EUR is the euro. CAD is the Canadian dollar. JPY is the Japanese yen. GBP, that's the Great British Pound. AUD, that is the Australian dollar. CHF, that is the Swiss franc. NZD, that is the New Zealand dollar. And then like MXN is the Mexican peso. Okay, guys, I want you to look at what you've written. If you notice that the first two letters in the currency abbreviate, they tend to stand for the country that the currency is associated with. The third letter typically stands for the name of currency itself. Always, this does not always apply, but it's commonly how it's done. For example, if you see in USD, well, the US stands for the United States, and the D stands for the dollar because that's the currency we use, the dollar. If you notice JPY, in JPY, the JP stands for Japan, and the Y stands for the yen because that's the currency that Japan uses is the yen. And then if you notice GBP, okay, well, the GB stands for what, guys? What does it stand for? Drop it in the chat. Right, Great Britain. Yes, it is the Great Britain pound because that's the currency that they use is the pound. Okay, so additionally, I'm just going to let you know you're going to get fluent in this Forex terminology. And, you know, sometimes you're even going to shorten it even more shorter than it already is, using the first letter for the currency pair. So, you know, if you are talking about the EUR USD, the Euro USD, you're going to find yourself sometimes just talking about it as EU. Or if you're talking about USD JPY, you'll find yourself, you know, dropping the terminology UJ. Is everybody still with me? Drop a 1 if you're with me so far. All right, at least taking good notes, guys. You're going to get it. You're going to get it. Great, great. All right. Next, we're going to talk about currency pairing. Write this down, guys. Currency pairing. Excuse me. And by its very definition, when you trade something, you're exchanging one item for another, okay? You're exchanging one item for another. In Forex, you're usually trading one currency for another currency, okay? Sometimes you may be trading a currency for like a commodity, but you'll note that currency exchange rates are given only for currency pairs, okay? Just for example, let's say, you know, you're from another country, you're visiting the United States, so you need to buy some US dollars. You exchange whatever, purchase those US dollars using the native country's currency. Likewise, when you want to sell those US dollars back because you're returning home, you simultaneously buy your currency in exchange, okay? The same principle applies when you're looking to make money by buying or selling currency based on your belief that its value will rise or fall. You must trade a pairing, okay? Write this down. The majors. These are going to be your major currency pairs. And like I said, don't feel overwhelmed at all of these abbreviations. It is new and you're going to get it, guys. You are going to get it. Don't be overwhelmed that all these currency pairs that you've got to get memorized, because let me tell you, there are well over 100 currency pairs available to trade at any given time, okay? So there is a small group of 7 pairs that make up over 80% of all the trade volume. Okay, these 7 currency pairs are referred to as the majors. So write this down, the majors. We've got number 1, EUR / USD, Euro USD. With number 2, we have GBP / USD. That's the Great Britain pound against the US dollar. 3, we have AUD / USD. That's the Australian dollar against the US dollar. 4, NZD / USD. There it is, the New Zealand dollar against the US dollar. 5, we've got USD / CHF. Okay, that is the US dollar against the Swiss franc. That CHF, that's one of the few instances where, you know, the country and the currency is not. CHF is Swiss franc. We've got number 6, USD JPY. And then we've got USD / CAD. So going over these again, number 1, we've got the Euro US dollar. 2, we've got the Great Britain pound US dollar. 3, we have the Australian dollar US dollar. 4, we have the New Zealand dollar and the US dollar. 5, the US dollar against the Swiss franc. 6, we've got the US dollar against the Japanese yen. 7, we've got the US dollar against the Canadian dollar. Guys, these are your major pairs. It's just 7 of them. It won't take you long to be able to recognize them. Amongst all the majors, the Euro USD, put a circle around that one because it's by far the most traded currency pair in the world. This currency pair, it accounts for like 30% of all the trade volume of the foreign exchange markets. One thing you're going to notice about the most heavily traded Forex pairs is that they all include the US dollar. Okay, we're going to learn more about why this currency and this associated major currency pair holds so much of the overall trade volume later. But for now, it's just important to be able to recognize these significant currencies so that as we get a little farther along, you can begin trading. Now, guys, write this down. The minors. The minors. Okay, in addition to the majors, there's another slightly larger group of currency pairs that make up an additional 15%. 15%. of all trading volume in the Forex markets, okay? So these are referred to as the miners. Write this down because sometimes you will hear these referred to as cross pairs. Cross pairs. And this is because their defining characteristic is that they don't include the central US dollar, okay? Instead, these pairs are crossed between other major currencies like the euro. Drop it in the chat, y'all. What is the abbreviation for the euro? There you go. Okay. JPY, GBP, AUD, CHF, NZD, CAD. I want you to write this down, so I'm going to repeat them for you, okay? These are minors, cross currencies, like the euro, the JPY, the GBP, the AUD, the CHF. What was that one, guys? CHF? Drop it in the chat. Yes, okay. NZD and CAD. For an example, a EUR, JPY, it's a minor or it's a cross currency pair because it doesn't include significant it does include significant currencies, but not the US dollar, okay? Y'all got it? Now, guys, write this down. The exotics. The exotics. Okay, because in addition to the majors, in addition to the minors, there's a final group, okay? It's called the exotics. It contributes to the remaining 5% of trading volume in the foreign exchange market, okay? I'm going to give you some examples of exotic currency pair. You've got, just say, the USD AFN. That's the Afghanistan Afghani. You've got things like the USD TRY. That's the Turkish New Lira. And you've got the USD IQD. That's the Iraqi dinar. I'm country. I don't really know how it's pronounced, but that's how I pronounce it. Cynthia, you want me to go through the minors again? Absolutely. EUR, JPY, GBP, AUD, CHF, NZD, and CAD. Now note, when any of these pairs are paired with the US dollar, it's a major. When they're paired against each other, it is a minor, okay? Now, we went through exotics, that's 5%. Another exotic is you've got the USD EGP. That's the US dollar against the Egyptian pound. The defining characteristic of an exotic currency pair is that you have a major currency, and it can be any major currency. It doesn't have to be the US dollar. It's paired with a currency of a developing, relatively smaller and insignificant nation economy, okay? These currencies, as their name implies, they're not traded very often, and for very good reason. As a matter of fact, it is not recommended for you to trade any exotic pairs as a newbie trader, okay? There are higher costs associated with trading them because there's increased transaction rates. There's lower liquidity levels, okay? And it just makes a way volatile exchange rate, okay? Exotics are dangerous, guys. Stay away from them at first. The USD WST is the Somalian Tala. All right, guys, write this down. Pips. Let's talk about pips. This is probably the most common term that you're going to hear in the trading world. A pip, write this down, is defined as the smallest possible change of an exchange price. A pip is defined as the smallest possible change of an exchange price. Okay, I'm going to say it one more time while you're writing it down. A pip is defined as the smallest possible change of an exchange price. Okay, it's also abbreviated for points in percentage. Pips are very important, guys, because you're going to be calculating them for each trade you take. The exchange rate for any given currency pair can be expressed using several decimal places. So it's very important that you note that pips are almost always calculated without using the last decimal position, okay? The very, very last decimal position, it's a fraction of a pip. It's called a pipette. Write that down, a pipette. The last decimal position of price is a fraction of a pip. It's called a pipette. Okay, guys, let's see here. I don't know how I did this. There we go. All right, I want to show you guys an example. Okay. Say you're analyzing the Euro NZD cross currency pair. You notice that the current exchange rate is 120.325. Okay, that's where the price is. Through your analysis, you believe the price is going to move up to 120.789. Just asking. If you take this trade and it wins, who knows how many pips you will have caught? If you know, drop it in the chat. Okay, good. Some of you know. Okay, now I'm going to tell you how you figure that out, Dynasty. So y'all remember that pips are usually calculated without that last decimal point, okay? So we've got the 120.789. Well, the 9 is a fraction of a pip, okay? Let's kind of drop it. You're going to take, you think it's going up, so you're going to take the higher number where you think it's going to go, and you're going to subtract where it's at, okay? That 120.325, well, the 5 is a fraction of a pip, okay? It's going to give you, when you subtract that, you're going to get 46.4. I think for homework tonight, Estella, I know you're on here. Can you help me? I want you to help. We're going to get them to calculate some pips. So if you'll just write out some things for me to give them, I'm going to put it in the E-Star Legends group, and I want you guys to answer the homework. Tonight for homework, we're going to calculate some pips. We do have like pip indicators and stuff that we can put on your charts, but I want you guys to be able to do it with your eyes, okay? I want you guys to be able to look at what you're looking at, okay? The price where it's at and where you think it's going to go. And I want you to be able to calculate those pips, okay? Hold on one second. All right, guys, write this down. The spread the spread. When you buy an asset, there has to be somebody on the other end willing to sell you that asset, okay? And just the opposite, when you go to sell an asset, there has to be someone on the other end willing to purchase that asset from you, okay? The lowest price a seller will sell a given asset is the ask price. Write that down. Ask price. The lowest price that a seller will sell a given asset. That is the ask price. The lowest price that a seller will sell a given asset. Now, guys, write this down. Bid price. Bid price. The bid price is going to be the highest price that a buyer will purchase a given asset. Bid price. The highest price that a buyer will purchase a given asset. You've got the bid price. Just giving you time to write it down. The bid price is the highest price that a buyer will purchase a given asset from you, okay? What a spread is, and I want you guys to write this down, a spread is the difference between the bid and ask price at any given time. The spread is the difference between the bid and ask price. When you enter a trade, you do have to pay this difference to your brokerage. And this is why, guys, and remember this, because I still get asked questions. When you enter a trade, your trade's always going to start off red, in the negative. Even if it's just for a little few seconds, okay? So it's to your advantage that you keep an eye on the spread before entering a trade so you can avoid unnecessary fees or losses, okay? All right, write this down, guys. Buying and selling. Buying and sell. Let me turn the light on, guys. I'm sorry, it's getting dark in here. Okay, buying and selling. You're going to hear the terms long and you're going to hear the term short when discussing trade positions, okay? Just write this down, guys. Long equals buy. Short equals sell. Long equals buy. And short equals sell. Okay. Everybody always remembers this part after I get done with it, okay? Next, write down market conditions. Market conditions. When discussing the market environment, you're going to hear the term bullish and bearish. Bullish means it's rising or increasing. Bearish means that it's falling, it's decreasing. All right, these terms were originally attributed to financial markets as metaphors, guys, of how the different animals attack, okay? When a bull comes after you, it thrusts its horns up, okay? Bull, what's it do? That represents rise, increase, okay? But when a bear attacks or mauls you, it does like this, you know, in a downward position, okay? So bearish represents, you know, down, a fall. So come on, guys, do it with me in the comfort of your own home. We've got bullish which is up. And we've got bearish. Come on, guys, do it with me. So you remember, bearish is down. All right, guys, write this down, okay? It's called validity. Validity describes how price is moving. If a pair has got high validity, it's going to be sharp, fast changes. In a market with low validity, we expect to be kind of finding price kind of what we call consolidating and not changing very much. Yes, honey, do that bearish bullish dance. Yes. Okay, so the enemy of validity is called liquidity. Write this down. Liquidity is just a fancy term for the amount of trade volume given in a market at a given time. Markets that have more liquidity, they've got more participants, and therefore more orders are being placed in either direction. Okay, this means that the validity will be lower because you're going to have many buyers and sellers kind of pushing the price back and forth. And it eliminates the ability for the price to either rise or fall too fast. I kind of think of it as a tug of war game. You know, you've got people pulling, people pulling, and at first, neither side goes very far. They're back and forth, just barely moving. And then as, one team gets tired, it'll kind of, go a little bit farther. Then the other team's getting a little whoop, so it goes a little bit farther. I always think of liquidity as that tug of war game. We got the currency pair. You remember the Euro USD, the one that we circled that accounts for 30% of the trade volume? It's got a lot of liquidity because it's got a lot of people trading it. Okay. So like the overall exchange rate for EU is not as volatile as, say, an exotic currency pair that doesn't have a lot of liquidity. Okay, this makes intuitive sense because it's commonly exchanged on a daily basis. The Euro USD, it really shouldn't see huge fluctuations in the exchange rate. If it did, it would cause a lot of problems. And as new traders, you may be tempted to seek out validity due to the potential for fast returns, but it's advised against it till you have more experience. Okay, you can gain it real fast and you can lose it twice as fast. So just remember that. There are benefits to sticking to less volatile pairs, such as the fact that the increased liquidity on these pairs usually results in lower spreads and a lower potential for losing money fast on bad trades. Concept check, guys. Concept check. Why does increased liquidity result in lower spreads? Well, remember, the spread's the difference between the bid and ask price on any given pair. So if there are more participants buying and selling a certain currency pair, this difference is going to be much smaller due to the principles of supply and demand. And we're going to go over that more later. Write this down, guys. Trade positions. Trade positions. In trading, the term lot size is used to describe how much of an asset you're trading at any given time. Okay? It's broken down right here into the various lot sizes and descriptions. So you've got a standard lot, 1.0. Write that down. Standard lot, 1.0. That is 100,000 units of currency. So when you're trading a standard lot at 1.0, each pip, point and percentage, gained or lost is equivalent to $10. You have got a mini lot. A mini lot is like 0.1. For every 0.1, that's 10,000 units of currency. So each pip gained or lost when trading in a mini lot is equivalent to $1. Mini lot, 0.1 equals $1. Then you've got your micro lots, okay? Your micro lots, 0.01. That is 1,000 units of currency. Micro lot, 0.01. Each pip gained or lost is equivalent to 10 cents, okay? So you've got the standard, the 1.0, that's $10 a pip. You've got the mini lot, that's the 0.1, that's $1 a pip. And you have got the micro, 0.01, that's 1,000 units currency. That's 10 cents a pip. And there's going to be instances when, you know, the gain or loss isn't exactly that amount, but this is just a good rule of thumb to remember, and it's going to be applicable to most currency pairs. Now, write this down. There are two significant factors. Two significant factors that determine the final outcome of any trade you take. That is, 1, your lot size, and 2, the amount of pips that move either for or against you. So the two significant factors that's going to determine your financial outcome is what? Your lot size and the amount of pips you either gain or lose. If you're still with me, guys, put a 1 in the comments. All right, guys. As we discuss trade positions, it's important for you to understand some basic terminology that you're going to come across when you deal with your brokerage, okay? Write this down. Margin. Margin is the amount of money that's available in your trading account. Your broker's going to require that you have a certain amount of margin in your account at any given time as collateral to cover your open trades. Okay? If your broker requires 2% margin, if you wanted to trade a standard lot, which is $100,000 units, you're going to have a minimum of $2,000 in your trade account, because 2% of $100,000 is $2,000. Okay? Margin, the amount of money available in your trading account. Now write this down. We're going to talk about leverage. I love leverage. I love leverage, guys. All leverage is the money you're borrowing from your broker to participate in the financial markets, okay? You know, in the aspect of trading, price typically moves very small increments, guys. We're talking fractions of a penny. So to make more substantial money by exchanging currencies, you need to be trading at a very large volume, okay? So for us, for the retail traders to do that, we need leverage to trade in the markets. It allows us to be able to trade a large enough volume to make substantial returns, okay? Here, they've got some simple leverage calculations, but you know, when you go to make your broker account and you go to leverage, you know, you're going to see 1 to 25. That means for every dollar you have in your account, your broker is going to let you trade it like it's $25. So if your leverage you choose is 1 to 50, for every dollar you have in your account, your broker is going to let you trade it like it's 50. So if your leverage was 1 to 100, same thing. For every dollar you have in your trading account, your broker is going to let you trade it like it's $100, okay? It's not uncommon to see brokers go up to 1 to 1,000. And what would that look like? For every dollar you have in your trading account, you could trade it like it's $1,000. So let's just say you had 1 to 1,000 leverage. Okay. You had $500 of margin. That's the money you have in your trading account. What is the maximum lot size you could take? So you've got your 500, your margin, the money you have in your account. You multiply it by 1,000, which is your leverage. That's 500,000 units. This is equivalent to trading a standard 5. That would be the max lot size you can take. Now, guys, when we get you in your broker accounts, when we get you on your MT4, you know, they calculate all of this for you at the top, but it's important to me that you know what it all means and what is going on with your money, okay? I love leverage. It's just so amazing. It's really what makes us able to earn a lot of money in the Forex markets. But you guys need to realize it's a great privilege to be able to have that. So it needs to be used wisely. It, you know, on the same level of what comes up must come down. Having leverage allows you to make a greater opportunity to make money, but just know that it opens up the possibility of losing a significant amount of money, okay? You've got great power with this, but it also comes great responsibility. I timed out. Sorry, guys. Yes, we're still here, honey. We just, can you still see the screen, Dynasty? All right, guys. So if you like what you're hearing and you like what you're learning, drop a 777 in the comments. If you're still with me, I want to see a 777. Okay, guys. This is just basics. This is just a lot of terminology. I'll need to see if we have time to go over this tonight. Do y'all want to go another 10 minutes? If you're okay with that, let's go over the industry, the Forex industry. Okay. All right. Write this down, guys. Market overview. Market overview. Okay, the foreign exchange market is comprised of many different participants. We've got at the very top, we've got the major banks, and they control most of the trade volume. They trade currency directly with another. Two different kind of electronic networks. These aren't even available to the public, retail traders like us. Okay, so you've got the major banks, and then you've got the other banks, the smaller banks. Okay, they come next in the terms of trade volume. Okay, these are followed by institutional investors and brokers. Finally, at the very, very, very bottom, you've got us. You've got your retail traders. Okay, now retail traders, write this down. We trade through various trading platforms. Okay, it's accessible from our computers, from our smartphone, from our tablet, basically anything that you can get a Wi-Fi signal on. Okay, these are connected to ECNs, which is electronic communication networks, otherwise known as your broker. We're going to talk more about brokers later. Here's a diagram. Okay. And you see it's kind of like an inverted triangle. Up here, you've got the major banks. And then you've got the electronic banking systems. You've got the smaller, medium-sized banks, the corporations, the hedge funds, the retails. And then right here at the very, very bottom, guys, you've got us, the little 5%ers. Okay, now write this down. Market hours. Now, these are Central Standard Time. Okay, so you're going to have to write this down, you know, for whatever for you. But basically, guys, the market opens on Sunday at 4 p.m. Central Standard Time, and it's open 24/7 until Friday at 4 p.m. Central Standard Time. So from Sunday at 4 to Friday at 4, it is open 24 hours a day, 5 days a week. Saturday, most of Sunday, it is closed. It's closed to us. It's closed to us as retail traders, okay? But interestingly enough, the Forex market never really closes. It runs 24/7. Our access to it is limited to more traditional business hours. That's when the retail brokers make trading available to clients. But thankfully, we don't lose the whole weekend. This is a worldwide calculation. If you're a trader in the U.S., business hours for the U.S. are typically Monday through Friday, 8 a.m. to 5 p.m., you know, just like regular brick and mortar businesses. But however, the Forex markets opens up to you on 4 o'clock on Sunday because that's equivalent to 8 a.m. in Sydney, Australia. That's one of the powerhouse trading markets. And another just interesting note is that while the foreign exchange market may be tied to worldwide business hours, it doesn't necessarily mean that all the markets are. Many retail brokers offer the ability to trade cryptocurrency, and some of the brokers allow retail traders to trade crypto 7 days a week. Okay. I don't even like to compare because I don't like to confuse people. But look, the U.S. stock market is open Monday through Friday, 8 to 5, regardless of the business hours and other time zones around the world. Okay. Write this down, guys. We have got your trading sessions. There are 4 major trading sessions, and I want you to write this down. You've got the London session, which is 2 a.m. to 11 a.m. You've got London session, 2 a.m. to 11 a.m. You've got the New York session, 7 a.m. to 4 p.m. New York, 7 a.m. to 4 p.m. We've got Sydney, 3 p.m. to 12 a.m. Sydney, 3 p.m. to 12 a.m. And we have got the Asian Tokyo session, which is 5 p.m. to 2 a.m. Tokyo, 5 a.m. to 2 a.m. 5 p.m. to 2 a.m. Now, all these are central times. Now, we're going to look at the breakdown of validity during each sessions. You can see, guys, that there is a lot more movement in the London and New York session than there is in the Tokyo and Sydney session. There's a lot more money moved in through these 2 sessions than these 2 right here. Your goal as a trader is to successfully capitalize on price fluctuations, which means you're looking at least some level of price validity. If you look at the hours of 7 a.m. to 11 a.m., you've got both the European and the U.S. sessions are open at that time. They're overlapping, okay? And this means all of the banks, all of the corporations, all of the institutions, the ECM brokers, retail traders, you know, they're all conducting currency exchange, and it's reacting to the fundamental factors that determine the price valuation. Okay, and all this activity, all it does is just breed a significant opportunity to capitalize on price movement. Okay, in contrast to the European U.S. session, you got the Asian and Australian
they're typically they have lower volatility. So during these sessions is when you're apt to see more of a price consolidation. We're going to talk more about that later. But price consolidation is where basically the market doesn't go up, the market doesn't go down, the market just kind of goes sideways. No movement to capitalize on. Okay, so then we've got holidays. There's less financial transactions taking place, especially like the bank holidays. You know, thank you. The bank holidays are closed. When the market's open and there's less financial transactions taking place, many market participants aren't conducting business because the global market isn't open for business, okay? We've got the market closed. Less financial transactions taking place where many market participants aren't conducting business late in the week because only a small portion of the global market is still open. So, and just, you know, in a general sense, understanding the overall structure of the Forex market is going to significantly help you as you learn technical analysis and you begin trading. This element is designed to provide you with an introduction to Forex and the necessary foundation to begin your trading journey. Okay, guys? So tonight we have went over basics. We've went over terminology. We've went over pips. We have went over margin. We've went over leverage. We went over a little bit of market structure. And tomorrow night, we are going to finish up with the basics, which is going to be the Forex trading basics and the Forex charting. Today is what, Monday? Is today Monday?
Yes.
Okay. This quarantine has got me like, I don't know what day of the week. So Wednesday is when we're going to actually begin the syllabus, okay, with Forex market trading platforms. Your homework tonight, guys, is if you go to the E-Star Legends group, I'm going to put in there some prices, where price is at and where you think it's going to go. And I want you to practice calculating your pips, okay? So you can drop the answers to the homework in the comments. So does anybody have any questions on anything that we've went over tonight? I know that, you know, it's a lot you're going to have to memorize, but as long as you took notes and you go back over them, these are terms we're going to be throwing around the rest of the time. And as we talk about them more, you're going to understand them more. And there's going to be a time where everything just clicks. So don't get intimidated because this is a lot of information. Repetition equals retention. So are there no questions for me? If you have any questions, just drop them in the chat. All right, guys, who's coming back tomorrow? If you're coming back tomorrow, give me a 1. If you're coming back for day 2, yes, yes, yes. If you're going to commit to me for these 2 weeks, put a 3 in there. Yes, thank you. Yes, yes, we're about to change the direction of your life, guys. Carolyn, do you want to say something, honey? Let me find you. You raised your hand. Do you have something to say? Carolyn, can you unmute your mic? If you have something to say. Okay, she said no. I guess she was just raising her hand because she's in it to win it, right? I know, guys, it's coming. Okay. Y'all have any questions? Just message me. I love you all. Thank you for your time, and I will see you tomorrow.